Hello, my name is Marco Bravo, and I'm a senior portfolio manager at AAM Company. AAM is an investment management firm that's been serving the insurance industry since 1982. I've been with AAM for just over 26 years and currently work with a number of property and casualty and life clients. I'm also the lead portfolio manager for our firm's MPL insurance relationship. Joining me today to discuss the MPL industry is my good friend, Tim Padovese from Ophthalmic Mutual Insurance Company. Tim, do you want to give a quick introduction?
Sure. As Marco said, Tim Padovese, ophthalmic is a little bit tough to say sometimes, so we refer to ourselves mostly as OMIC. We insure over 60% of all the ophthalmologists in the United States. It's a little niche in the insurance industry. We provide medical professional liability, or med-mal is often referred to. And we also provide a few ancillary coverages that we reinsure, but our primary focus is med-mal, medical professional liability for physicians.
Thanks, Tim. We're going to discuss the MPL industry today, and we're going to start with talking about some of the challenges that MPL writers are facing today. You know, prior to COVID-19, the industry was facing multiple challenges, such as falling premium volumes due to a consolidating customer base, and also rising payouts due to increasing jury awards. Recently, kind of AM Best made the statement that kind of really the full impact on MPL writers from the pandemic will take some time to determine. Tim, what are some of the challenges that COVID-19 has brought to the forefront for MPL writers, in your opinion?
Yeah, well, you know, COVID has thrown all of us a curve. First of all, from an employee-based standpoint, you know, we had to turn within 3 days to get a workforce that was about 40% in the office, remote, and so we did it. And, you know, we now look back 18 months later, I guess we all thought it'd be 3 months, maybe 2 months, and we'd be back, but that has not been the case. For our physicians, our insured physicians, it was a challenge, initially a major challenge. Ophthalmologists, they closed their offices. They could not see patients. They were not deemed as that group that needed to see emergency patients. So we had a number of physicians, most of them stopped seeing patients. So we did a COVID relief, or a one-time relief to our members. It was amounted to 12.5% that we pushed back into their pockets. That had an impact on us, on our financial results last year. We felt it was the right thing to do. So the industry overall, we have seen some things happening that continue to happen. Our physicians they're up to about 90% of their seeing their patients, and maybe even a little bit more now. But they lost some patients. Some people just stopped coming out of their homes. So it's been a challenge. The whole industry in general has been a challenge. And the one thing I want to mention, I just read a statistic that we're now up to 75% of all physicians are insured through hospitals, are in hospital settings. So that doesn't affect ophthalmology as much. It's definitely affecting my fellow MPL writers. And it's a trend that has continued. The last thing I want to mention is we've seen private equity coming into the whole physician business, and we've seen it in ophthalmology. So we had to turn on that as well and produce more business with private equity, as the lead.
Tim, some of the experts in the industry are discussing, the challenges and the possible risks that they see kind of in the future. And one of them you kind of hinted on is patients kind of postponing non-essential treatments. And so we're going to see those patients return and start receiving medical treatment. And then the uncertainty surrounding really what liability physicians and healthcare providers have with COVID. How is OMIC, how are you positioning OMIC to manage these potential challenges and risks that we may see in the future here?
Yeah, we have a big focus on risk management. And so one of the things that we've been working with all of our physicians, we've been sending out information on this, and that is, kind of the potential concern of abandoning patients and stuff that could come even though the patients stop coming. So that is a concern, I think, long-term for our MPL industry in general, that some patients just stop going to see physicians. So we have done quite a bit of education. We've encouraged our physicians to reach out to those patients that have more serious issues that really do need to have a follow-up, more prominent than some others. And so how that's going to impact claims overall, none of us are 100% sure. We could see some plaintiffs groups, kind of using that as their argument. Whether it will stick or not, we'll just have to see.
So it sounds like for sure it has forced you to think about your ERM, enterprise risk management framework, and look for areas where there could be weakness in that framework.
Yeah, so ERM is interesting. That really has come into our industry, probably over the last 7-8 years. And, we're evaluated by AM Best, and we recently had a meeting with them, and we actually created some information on COVID that, really talks about the impact that could have on our company. And we created a few slides. We talked about how that might impact that. The whole overall, impact of, you have the whole environmental, social, governance issue, ESG, that really is evolving. So you have COVID here and all the stuff going on there. And you have, what's kind of a growing presence of ESG in the insurance industry. So I think, going forward, we're going to be looking at things, investments, it's kind of a natural, it's naturally a place where ESG, I think, considerations can be observed. And one of the things that we talked to AM Best about is, where we're investing. We're looking at social issues. We are looking at the whole environment around investing as well. So whether it's a negative screen or part of a fundamental credit, analysis to make better decisions. So yeah, there's change happening out there, and we're seeing it.
Since you brought up ESG, I want to share a screen here real quick for the audience that shows kind of where the source of kind of pressure among stakeholders is coming from with respect to ESG. And right now you can see, and this is an exhibit from an AM Best, that the main source of requests for information or pressure per se is coming from the regulators and the rating agencies. investors, I'm assuming that's really more for publicly traded companies. But as far as customers and employees, not so much pressure. So it's really from a regulatory and rating agency perspective. And you're right, it's an evolving topic. It's one that is garnering more and more attention. We expect to see surveys coming from state regulators, from AM Best. Thus far here at AAM, our focus has really been to position ourselves and provide our clients the tools and the information that they need to fill in any surveys or requests for information that is coming from the regulators. And I'm assuming is that the extent that you've seen so far on your end?
Yeah, we've gotten inquiries from states. We're in every state, so whether it's California or New York or other states, they have brought some questions forward to us. Rating agencies, as I mentioned before, AM Best, they have an interest in this, and I will tell you, for us, a little bit more pressure, I think it's 14.5% or something like that for employees. Our employees are putting even more pressure on us to, we have a diversity policy, and they are putting more pressure on us just to ensure that the company that they work for is really paying attention to this issue. So, you're getting pressure from a number of places, rating agencies, states and legislators that are interested in how you're handling your business. And then in our case, more from employees.
Yeah, for sure. So I think on this topic, though that request for information is coming, and companies need to have the tools and the data available to provide that information. Going back real quick, just to the industry. The industry feels like has suffered with increasing loss ratios due to social inflation. What's happening on the reinsurance side? Are you seeing rates rise? Just give me a sense of what's happening with reinsurance.
Yeah, absolutely. So, I think the industry in general has definitely seen increases in from reinsurers. I think the problem is, reinsurers, they do everything. We would just like to see a reinsurer that only does MPL, but they're doing property. They're doing, a lot of business interruption. They're affected by COVID in a lot of different ways. So they are getting pressure from within their company to push rates up. So we've been fortunate. I think our book has stood the test of time. It's a very predictable book of business overall. And, we've been in business 34 years. So we have a pretty strong track record. Nonetheless, we too are seeing pressures from reinsurers to up premiums because there's an unknown that reinsurers are dealing with. They play up here. We're in the trenches. Insurance companies, maybe keeping the first 1 million, or depending on the company, the size, 500,000 or maybe 2 million of every loss. But everything above that is handled by the reinsurers. And so I think that they feel their stake is a little bit more risky right now.
Is a hard market coming for the industry?
I think we've seen some increases for sure. And I think part of that is based on the unknown. We have seen some prices going up. I've seen some studies, national studies where 5%, 6%, 7% rate increases are happening. And so, yeah, I think there's a little bit. The issue for the MPL industry is, I think all of us have a lot of equity. There's a lot of equity sitting on our books right now. So I think we can withstand a little bit more pressure from a price standpoint. But nonetheless, if you look at combines, they're going up. And ultimately, as combines go up, you're going to have to get a little bit more premium for your product.
Yeah, that I was reading an AM Best article on the industry recently, and although they have the industry on negative outlook, they do cite the well-capitalized balance sheet of the industry.
Yeah,
COVID,
we're all in a very strong position, Marco,
Yep.
and than what we were, boy, 10 years ago, 15 years ago. Our industry was hurting, really hurting. Back in the early 2000s, we had companies going under, and I think a lot of people realized that and got healthier. But nonetheless, you kind of have to watch you gotta run your balance sheet, your income statement to make sure that you're adequate in all areas. And frankly, you got to make money on your product overall. Telemedicine
seems to be a growing topic and use of telemedicine, especially coming out of COVID. Is that affecting your business at all, Tim? And does it introduce a new set of risks or challenges?
Well, it actually has moved in ophthalmology. I will tell you, in 2019, if you told an ophthalmologist that possibly as much as 25% of their business would be telemedicine, they'd say you're crazy. Because at the time, we were maybe 1%. COVID hits, paradigms shift, and all of a sudden, telemedicine has become a bigger part in the ophthalmology industry, but it's also a bigger part in all of MPL. All of my, fellow companies that do, everyone from A to Z, whether it's a general practitioner or, a neurosurgeon, they're doing things online that they never thought they would do. And I think it's here to stay. I mean, I really do think that telemedicine is, it's here to stay. And, it's interesting. We really haven't seen many, if any, frankly, losses tied to telemedicine. It's, we'll have to see as it evolves, but there are very, very few losses, again, if any, tied to telemedicine, and that's the case in our industry. And I mean, in our company, I can't speak overall, but I know I've talked and heard from a lot of people that very, very little claims activity coming from it.
Interesting, very interesting. Yeah, we'll see how that evolves in the years ahead. Let's jump from the liability side to the asset side, that the asset side is not without its challenges as well. Investment income ratios have continued to decline given how low yields are, and the additional spread that's available in asset classes has narrowed, making for a very challenging investment environment for fixed income investors. And MPL insurers are invested similar to other P&C insurers, where the bulk of the assets are in fixed income securities. Yep. Tim, I believe OMIC has roughly about 80% of its assets in bonds. Yep. How are you, navigating this low yield environment today?
Yeah, I mean, it's a challenge for all of us. Anyone watching on this call, or frankly, anyone that's investing, period, there are challenges. We have even tougher challenges because of our requirements, as you said. We just can't, move 50% into equities. It just doesn't work for our business. We need to be in, fixed incomes. And so as an insurance company, we need to have a large amount in that, in that bucket. OMIC's been fortunate. We've had some strong underwriters, and we don't need the investment income. So we hold our investments we don't have to sell bonds early. So we hold them to maturity, and we look at, we have, we're very careful on credit spreads. We are very careful on the quality. Years ago, you could have, a portfolio that was primarily AAA and have a decent yield overall, but that's not the case. So now you have to mitigate. We do have some Bs. We work with our investment committee, and we have added some Bs. We have, we've increased a little bit in our equities, and then we're constantly having to kind of rebalance because it's a percentage of our surplus, and because the equity markets have done so well, we've had to pull some of that and rebalance back into bonds. But I think overall, we don't rely as much as maybe some other companies on the income per se. We'd all like to get more yield, but it's pretty tough to get. So you're balancing equities, you're balancing your bonds, you have a little bit in cash that you might need for something, and there's some other vehicles that you might. I know some people, we've done a little bit in private placements. So there are some things you can do, but it's tough. It's just a more difficult market.
Absolutely. With spreads tight, or you're just not getting paid a lot today to take risk, to go down in credit. And what we tell our clients and how we're managing portfolios now for our clients is looking for unique opportunities, where we can add some yield, like private placements, certain non-agency related structured securities. But the things you don't want to do in this type of environment is stretch for that additional yield and take risk that is not commensurate with your risk tolerance, because you're just not getting paid to. And there will be opportunities in the future. So you want to keep some dry powder, we believe, in today's market to when that blip comes. And we just don't know when it will come, but it will come. Markets don't stay on a one-way street forever. You want to have that ability to take advantage.
Marco, on that, I would just tell you, as a CEO, I have investment, consultants that I work with. I have, CFO, we're always looking. But you're right, you can't let that risk get too far, because on this side, you could have some problems. So what you do is you end up, keeping it where it's good, it's comfortable for your appetite, and not going too far one way. And then you just have to, you manage it that way. Absolutely.
Sticking on the investment theme, a report that I was reading suggested that most of the net profit in 2020 for MPL writers seems to have largely come from realized capital gains. And with the large investment in fixed income and the potential for inflation to drive interest rates higher, that ability to take gains from bond portfolio could diminish. Just curious, Tim, how are you, or are you concerned regarding the impact that rising interest rates could have on your portfolio?
It's interesting. As an insurance company, we get a benefit from statutory accounting, which allows us to hold bonds, at book value rather than to market. So I think if you hold those, and our strategy has always been to hold those to maturity, then we've gotten those benefits. But I have some 7-8 year old bonds that are rolling off at 4.5, and I'm reinvesting at 2.5. So those are painful, but we ladder our portfolio. We try to mitigate that as much as possible. To be honest with you, I wouldn't say bullish, but I'm okay. I wouldn't mind seeing some interest rates increases because we think that that will ultimately give us better opportunities for that money coming out of our portfolio, our ladders, to reinvest at a higher, reinvest at a higher limit. So not freaking out over interest rate increases at this point.
Yeah, I'm with you there, Tim. We would welcome higher rates, even though that is going to reduce the market value of the bond portfolio. Like you said, if you have the duration correct and you have a
Yeah.
laddered maturity profile and you don't need the cash flow from the portfolio,
Yeah.
we'll take the higher reinvestment yields that will in the long run lead to increased investment income. Inflation is definitely will have an impact on the asset side. It also could have kind of an impact on the liability side. Do you see any threat with respect to inflation driving severities higher?
That's always, yeah, I think the short answer is yes.
Yeah.
As if we really saw, I mean, we're not going to see well, I do not believe we'll see an early 80s inflation spike that, we all, us gray hairs anyway, Mark, you're probably too young for that, but
I got some
lived, well, let me tell you, we lived through that, when we saw double digit, I worked for another company at the time, and we couldn't get our agents to pay their premiums that they were collecting from their insurers because they were making so much money on their money. But I think it will drive. I mean, if inflation goes up, that's going to be, the courts will have to deal with that. Your attorneys are, they, what's that? The boat rises or whatever. We'll definitely, we'll see it. Yeah, there's no doubt about it.
I want to talk a little bit about tax-exempt municipal bonds for a moment. In 2020, our research shows that roughly about 9% of the total bond income earned by MPL writers came from tax-exempt municipal bonds. When the corporate tax rate was lowered to 21%, the yield available on tax-exempt municipal bonds really unattractive relative to what you can get from taxable alternatives. I'm going to share another slide here. And what this chart here shows is the green line represents the yield available today on AAA rated tax exempt municipal bonds on a grossed up basis, assuming a 21% tax rate. The dark blue line is the treasury yield rate. And you can see how well below that blue line that green line is. And then the taxable municipal bonds is the light blue line. And so a lot more attractive investment opportunities in other asset classes. And even if we do see a higher tax rate in upcoming legislation, and that's a big if, but even at a 25 or a 28% tax rate, which is shown by the red and the yellow lines, at current levels, tax exempts are still very unattractive. So we've seen the industry and the MPL industry kind of reduce their tax exempt holdings, but I was still surprised that it's still a fairly large component of total income. So I'm curious for OMIC, Tim, how are you viewing tax exempts within your portfolio as part of the overall fixed income allocation?
Yeah, so, if you go back, and I think one of the reasons, Marco, a simple answer that it's still, fairly, big investment for, the industry in general is the majority of us were so big in the tax exempt market that once once the tax laws changed, we're changing our allocation, but we're getting off of it when it makes sense for us. So, for example, at OMIC, at one time we were well over 60% in tax exempt municipal bonds. so over the last 2 years, 2.5 years, we've moved that down to 35%. And during that period, we've moved our taxable municipals up from, I think we were around 3% to about 15%. So we are moving in that direction. We're holding them again to maturity still for us. Most of what we invest in the municipal market is, I want to say, is pretty safe. Overall, we've never ever had an issue. We primarily look at kind of infrastructure, water, sewage, that kind of stuff that tends to, continue. But we see, unless there's a change in the tax program, we see that continuing to decline. And our projection probably is getting around 20% within the next 12 months. So think about that, going from, nearly 70% down to 20% and then reallocating that money.
Thanks, Tim. Well, our tax exempt municipal expert here at AAM, our trader, believes that we may see a situation that results in increased issuance from tax exempt issuers, maybe late second half of this year or early 2022. And we're not expecting an accompanying increase in demand from investors. So that does have the potential for providing perhaps some better buying opportunity maybe in that space. So we'll definitely keep an eye on that. The final topic for today, Tim, I want to discuss is kind of asset allocation and kind of how we think about allocating the assets across not just in investment grade fixed income, but across other asset types as well. And the chart here shows the asset allocation as it stood at the end of 2020 for both MPL writers and the overall P&C industry as a whole. And you see no real significant differences, large portion in investment grade bonds. Equities represent the largest allocation to what we'll call risk assets. Risk assets being anything other than investment grade fixed income. And then, I'm sure for mostly operational purposes, a large cash holding as well. When we think about allocating to away from investment grade fixed income or into risk assets, we think that the first and most important focus should be defining risk tolerance. And the way we think about risk tolerance is, what is the maximum amount of surplus that you're willing to lose or can lose in a stressed market environment. So, we define a stressed market environment as a 1 in 200 event or a 0.5 probability event. How do you think about risk tolerance, Tim, when it comes to allocating away from your core fixed income portfolio?
Well, we define investment as a potential loss of value. Let's kind of first just say that. We look at primarily bonds and stocks. So if I look at bonds, for example, we look for high quality, and then we balance the yield. So yes, there are some B-rated bonds out there that are, household names, companies that you've heard of that you deal with every day that still give us protection and might give us a little bit more yield. So, so we try to balance that. Stocks, companies can have problems, I think, when, we mitigate that risk by investing in, we try to mitigate that by investing in kind of large, diverse exchange, traded funds. So we're not investing in just an individual company per se. We've got a little bit of a protection, in ETFs or so there is that little balance. Their values can fluctuate. We know that, and maybe returns might not meet our expectations, but they're measured as a percentage of our portfolio, and then we adjust them. We adjust it to surplus. So, as I mentioned earlier, we do have we have a few private placements that we did a tremendous amount of underwriting on and felt really comfortable with those particular companies. We don't have a huge play in it. We might have $1 million to $2 million in that, but nothing more than that.
When it comes to thinking about other asset classes away from fixed income, as we work with our clients, we ask them, what is the objective? Is it to increase investment income, which would tend to kind of skew the risk asset allocation towards high yield bonds, bank loans? And today we think bank loans offer better value than high yield bonds do. Or is it for long-term capital appreciation or total return, which would kind of skew the allocation to risk assets towards equity or equity-like investments? Today, given what appears to be high valuations for the equity market, although it continues to move higher, today we think convertible bonds that provide the investor exposure to the equity markets, but provide some downside risk if we do see a correction. As you think about objectives for OMIC, is it skewed more towards increasing long-term capital growth, investment income, or a combination? How do you
I think it's fair to say it really, we look at it as a combination. When we look at risk assets, we talked about the equities, we talked about bonds, some private placement. We view our allocations as percentage of surplus, and then what is our tolerance? I mean, how comfortable are we? It's that old, sleep at night. If you feel that your portfolio is too risky, you're waking up in the middle of the night. You're just like not comfortable, like, maybe I'm not exactly where I need to be. So we've always given our equity ranges, it's like 13 to 18%, and then we rebalance. I mentioned that earlier. And then we move into, we move some of that growth, frankly, back into a more conservative bond, because you don't know. I mean, we've had a great run in equities, haven't we? Yes. Whether it's my personal investments or our company's investments, we've had challenges to keep pulling money out to reinvest. Had to pay a little tax on that, but it was worth it to keep us within the range. So we're in a strong position. We don't need to chase yield or risk assets, but there's a balance.
Tim, I'm curious, that 13 to 18% range you mentioned, how did that come about? Was there any type of quantitative modeling that was done to determine what that appropriate range for equities was or is for OMIC?
Yeah, it's a good question. One, we work with our investment committee and our advisors, people like you that, have a tremendous amount of knowledge in this area. We also work with our actuaries. So we at OMIC do an annual modeling. We look at, I always get the words wrong, but it's stochastic. It's one word I can never. I don't know why. There's certain words I just can't get out. And then, which looks at, we look at, 95,000 or whatever the number is. We do all the different modelings to say that, you know, this chance of this happening, you know, is so remote, but yet it could happen. So, I mean, we look at those. We also look at single scenarios and how that might affect the company. And then we grade it by, you know, insurance and investment aspects. So we do modeling every year. You know, I always tell the board that we basically try to break the company. And frankly, you could do a few stupid things in the insurance business for a few years and still look pretty good. But then it catches up to you. So, you know, I think I mentioned earlier, you know, back in the early 2000s, you know, we saw some MPL companies go out because they were doing some things that they probably shouldn't have been doing, obviously, as they went bankrupt. But their books looked pretty good for the first couple of years, but then it caught up to them. So I think modeling does that, you know, that you can see, okay, if we do this, what is, you know, how does our, you know, investment, you know, how does our company look overall? So we take, you know, our actuaries work with it, our investors, our investment folks work with the modeling, and then we create scenarios that we know what is most likely going to happen. And then there are those outliers, but they're rare.
Yeah, I think it's very important to know what could happen with the outliers. You know, your typical portfolio optimization modeling usually defines risks as long-term standard deviation of return. So it's over a long-term period. But we all, you know that we live month to month, quarter to quarter, year to year in the insurance industry. And if one of those tail events were to happen, you know, do you have the tolerance to withstand that that event from happening? So glad to hear that you're looking at that.
Absolutely.
Well, Tim, I think this was a great discussion. I really appreciate you taking time today and having the discussion with me. I hope everyone enjoyed it as well. So thank you very much.
Thank you, Marco.